Fed gets data as US shutdown finally ends. No conundrum for RBI and my take on Microsoft. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode 145 of the Stock Doctor podcast. Well, if you basically missed the entire week of trading in US markets and you looked at the US indices, on Monday morning, and today morning for that matter, then you would certainly be forgiven for thinking that pretty much nothing happened. The reality, unfortunately, is far from it. I did tell you, I feel like the theme of 2025's, the entire show is volatility is the name of the game. I should just rename the show as volatility is the name of the game, because I think I've told you this 1,000 times, more so, probably more than I've uttered the word the Stock Doctor podcast. But it's true, though. The reality is far from it, because volatility is the name of the game. The unraveling of AI trade, especially, accelerated last week, and you would not even know. You would not even know that happened if you just looked at, if you missed the entire week and you just looked at your portfolios today. Unraveling of the AI trade accelerated as tech valuations continued to weigh on investors' minds last week, sold off the big tech names. But the positive news on trade deals, as well as the US government finally ending, the US government shutdown finally ending, and the government finally reopening after the US of longest shutdown in history, both the trade deals as well as the shutdown ending were definitely offsetting factors. The end result, when you have one negative and two positives sort of kind of offsetting each other, the end result, all three indices of the US markets pretty much ended up pretty much ended flat. Once the dust settled, the Dow was up 0.3%, S&P 500 up 0.1%, a tech-heavy NASDAQ slipped about 0.5%, which in the grand scheme of things, well, let's just call it market was flat. It doesn't really, like I said, you wouldn't even know the difference, or you wouldn't even know the pain you had to go through on some of the days and some of the joys you had to go through on some other days, essentially offsetting each other. So let me welcome you to the first segment of this weekly snapshot, as always, and take you through the key developments of the week. We began, as I said, with we began the week, as I said, with the longest government shutdown in U.S. history finally coming to an end. President Trump finally signing the spending bill and announcing the end of the shutdown. The shutdown resulted in furloughs and delayed paychecks for federal workers, disruptions in air travel, with airlines canceling up to 6% of the flights as until Friday, although it was a much better weekend, closure of national parks and museums, and threats to food benefits for millions of households. Crucially, for investors, from an investor standpoint, important economic data releases were also delayed during this particular period. And this is what I wanted to say. Investors, and more importantly, the Fed, will finally gain access to key economic data in the coming weeks, with the government announcing that they will be releasing the September jobs report this Thursday. That's about 2 days from now. And the jobs report, even though it would be a stale one, could still be vital given the growing concerns about labor market weakness. The last available monthly jobs report, which was published way back in September 5th to be precise, found that employers had created a meager 22,000 jobs in August, and that the unemployment rate actually ticked up to 4.3% compared to 4.2% previously. The jobs report also, September jobs report, even though it is stale, as I repeat, also becomes crucial, given that the White House announced that both the October inflation report and the October jobs report may never ever be released as a consequence of the shutdown, a so-called data black hole, as one could call it. This means that the Fed would actually go into the December meeting armed with, let's put it this way, a stale September jobs report and the November jobs report, which is set to be released on the 5th of December. Thankfully, now set to be released on 5th of December thanks to the shutdown finally ending. That's it. They all get a stale. All they get is a stale September report and a November jobs report. That's pretty much all that the Fed will have on their hands as they enter the crucial December meeting. No October CPI data. The November CPI data will actually be released on the second day of the Fed meeting, as they are in the office, debating all these decisions, what to make of the interest decisions. That's when you get the November CPI data. So I'm not sure how much that would play into the minds of the Fed officials, or how much time they would have to actually read through the report, because they would literally be in the meeting when the data plays out. Technically, we should get the October PCE index report, although at the time of recording of the show, I did go to the website of Bureau of Economic Analysis, which publish the BEA, which publishes the PCE report. There's no date mentioned on the time of recording, at the time of recording the show as to when the October PCE would be released. So I'm going to call it a complete data black hole even on that front for the Fed as it approaches, as it enters the December meeting. So on the inflation front, the only data, if one can call that, would that the Fed would have is the potential of the potential, essentially, like I said, if you can call it data, so be it, is the potential of reduced prices going forward, thanks to President Trump issuing an executive order over the weekend, on Friday actually, that lowers duties on beef, coffee, and over 100 agricultural goods in response to the rise of cost of living among Americans. However, given that the White House has already expanded tariffs on other industries such as steel, aluminum, and autos, not quite sure exactly what the Fed will factor in and how the Fed will factor this new executive order in, because it's not exactly data, it's essentially anecdotal evidence, or rather anecdotal evidence the Fed will have to construct based on potential scenarios that could play out because of these reduced prices, because of this executive order reducing prices. I'm not sure exactly how much good that will do to the Fed, how much good that will do to the investors. If such a data, I mean, would look at the Fed commentary, I suppose, but I'm not sure. So on the inflation front, pretty much zero, zilch, nada is what the Fed will have at the December meeting. Now, having said that, given that Fed Chair Jerome Powell and other Fed officials have repeatedly said that they would be focusing on the dual mandate, jobs and inflation, it is looking increasingly unlikely that they would make a further rate cut in December. Like I said, zero inflation data to go with, 2 jobs report, one of which is stale to go with, and you have a completely hawkish Fed at the minute when they talk about with respect to December rate cuts at least. So it is increasingly looking increasingly unlikely that they would make a further rate cut. According to CME's Fed Watch tool, the probability of a rate cut in December has now, currently stands at 43.6%, which is a steep decline from where it was a week ago, and that was at 62.4%. And when you compare it a month ago, it's completely broken down. You can basically, it's as good as zero, because a month ago, the odds of a rate cut stood at 93.7%. So not exactly. So from 93.7, we currently stand at less than 50%, which is 43.6%. So pretty much you can kiss goodbye, I suppose, to a December rate cut. Fed officials last week were very hawkish indeed, with Cleveland Fed President Beth Hammack saying the Fed had to remain somewhat restrictive to bring inflation down at a time when both of the mandates of the central bank, inflation and jobs, have been under pressure. Hammack's remarks comes a day after Boston Fed President Susan Collins said she was cautious about further rate cuts due to the lack of economic indicators. Also last Wednesday, Atlanta Fed President Raphael Bostic said inflation continued to pose the most urgent risk to economic stability. So all in all, with each passing day, it looks increasingly unlikely that we would get any more rate cuts in 2025. Looks like, things can dramatically change, of course, between now and December 9th and 10th, but it is looking increasingly unlikely that, Thursday's jobs report probably be a first sign of things to, probably how it goes. And if that also goes negative, you can pretty much say goodbye to any rate cut in 25. Now, in addition to hawkish comments from the Fed, the markets were also rattled by the continuation of the unraveling of the AI trade, something I talked about at the beginning of the show. But this week, there was a twist. Okay, last episode, I did tell you that was it was a broad-based sell-off driven by the AI trade mostly. But this week, it comes with a twist, as the sell-off was pretty much restricted to tech stocks, as the great rotation was back again. Investors rotated into perceived safer sectors such as energy. Healthcare also saw some buying. So anything other than tech pretty much saw some buying saw some positive offshoots courtesy of investors undertaking the great rotation once again. Whether the rotation is here to stay is a whole different debate, but that is what the trend was in last week's trade in the US markets. Now, over the last couple of episodes, I've been saying that I do believe the reaction to tech stock valuations, at least with some of the names, I've already mentioned the names, Meta, Nvidia, and so forth, and so on and so forth, have been overdone, and that the current sell-off remains a buying opportunity for some names. I mean, if you look at Alphabet, it's now up on Monday, it was up about 5% before the market opened. And that's because Warren Buffett, in his 13F filing for Q4, did say that he's got a new stake. I mean, Berkshire Hathaway did announce a new stake in Alphabet, and it's a fresh new stake. So that really gave some boost to the news stock. I'm looking into buying Alphabet myself. If it, 5%, I'm like waiting to see if it stabilizes around that, or if it goes, if there is any pullback, I would probably be initiating a new position on Alphabet. So I thought you guys would like, not because Buffett's buying. It's great that Warren Buffett is buying, Berkshire Hathaway is buying, but you will see in a couple of weeks when I do present Alphabet as one of the Dr. Dissects, that it is looking very, very, very prominent from an AI perspective, and that the capex spend may not be as diabolical as some investors look out. So I'm not surprised that Berkshire Hathaway did take a stake in Alphabet. I think it's a fantastic move. But then again, when has Warren Buffett ever gone wrong? Most of the times he's spot on. Now, I do get the pause, however, in this AI trade and the unraveling of the AI trade. And I do think that investors should wait until Thursday morning before starting to look at the names to buy again. And that is because the Super Bowl of the Q3 earnings season is upon us. And that would be on Wednesday as AI behemoth NVIDIA reports its Q3 numbers. Even though everyone knows that NVIDIA's quarters will be good one, given the commentary we've received from the company's customers, one of which I will be dissecting a few minutes from now, the entire AI's short-term direction, or rather for the rest of the year and possibly into the early months of 2026, will hinge on Jensen and Co. So no pressure, Mr. Huang, no pressure at all. Any weakness on any of the metrics that NVIDIA reports, especially the data center revenues, or any guidance, any sort of guidance, any commentary on guidance, if there is even a hint of weakness there, no matter how small it is likely to lead to a sell-off. Definitely, at least given the fact that so much investors, so much jittery already when it comes to AI trade, it's definitely likely to lead to a sell-off as we are heading into the report, into NVIDIA's report, on the back of a significant negativity. However, I've been repeating this for a couple of episodes now. If you are a long-term investor like me, you should be counting on this overreaction, since it would be an epic buying opportunity, in my opinion. On the very positive note, at least from the buying opportunity sense, I'm going to take you straight to the next segment, Dr. Goes Home, where we discuss India, where the entire mood is, it's like the festive season never ended in India. The investors are in a very upbeat mood, and why wouldn't they? Because it was yet another week of a lot of positive data and news for Indian investors. So Indian investors, the Diwali party continues, the festive season continues. The most important, because it was a lot of positive data. Most important of all was the inflation data. I did touch upon it a little bit last episode. We actually got the inflation data this episode, last week. So this episode again, we actually got concrete results on inflation, which actually slowed the CPI in India. Actually, the data slowed to a record low of 0.25%. That's not an error. I will double, triple check multiple sources. Yes, it slowed down to a record low of 0.25% in October, down from 1.54% in September, and coming well below economists' expectations of 0.48%. This marks the fourth consecutive month where inflation remained below the RBI's medium-term target. RBI's the midpoint of the range between 2 to 6%, the 4% range. But 0.25%. Where is 0.25%? Where is 4%? It's insane how much inflation has fallen. It's fallen off a cliff essentially. The sharp decline in inflation was driven primarily by a 5.02% year-on-year fall in food prices, which make up nearly half the CPI basket. Contributing factors also included the impact of GST rate cuts, favorable base effects, and reduced inflation in categories such as oils and fats and vegetables. Vegetables declined actually 27.6%. A couple of years back, when I reported inflation in India, when I used to report inflation numbers, I used to say vegetable prices went up 35%, 27%. Little did I know that 2 years back I'm reporting the same figure, but this time reversal. This time on the other in the other direction. So oils and fats, vegetables, declines in eggs, footwear, cereals, transport, and communication all contributed to lower inflation, the record low inflation of 0.25%. I got to repeat it every day because it's so surprising. I got to keep repeating it again and again. Core inflation, though, if you remove the food and energy costs, which tend to be volatile, while it came at 4.2%, it did remain very much contained and very much so. It's all in all, it's fantastic picture. The CPI gave you a fantastic picture if you're an Indian investor. Now, India's WPI, the wholesale prices inflation also came in weak, slipping back into deflation in October 2025, driven by a sharp decline in food prices. No surprises there. WPI inflation registered a negative 0.5% year on year compared to 0.13% last month and 2.8% year over year earlier, with food items accounting for the bulk of the downward pressure. No surprises there. Notably, food, about 1/4 of the WPI recorded a deflation of 5% in October, much steeper than the 1.9% fall seen in September. Vegetable prices fell 35%, pulses dropped 16.5%, cereals dropped 1.1%, and fruit prices were down 7%. Potatoes and onions also saw spectacular drops of 39.9% and 65.4%, respectively. I mean, onion prices going down 65% is a head scratcher to me. I mean, it's insane. It's fantastic. Great for the Indian consumer. Extremely happy with the number as well. At one point, potatoes, onions, tomatoes, all were like rising, rising like it was massive skyscrapers. The price figures. It's really heartening to see prices going the other direction now. The drop was further supported, as I said before, by recent government tax cuts, favorable base effect, and as well as the two-slab GST structure. Which notably lowered taxes for household essentials and consumer durables, which actually contributed to the overall decline in WPI metric. Now, the combined benign inflation data, CPI and WPI, does bat for another rate cut of at least 25 basis points at RBI's next meeting in December. RBI Governor Sanjay Malhotra did note that the inflation outlook has become more benign, driven by lower food prices and rationalized GST rates. However, there are caution is warranted here, posed by geopolitical tensions and potential trade disruptions. Furthermore, festive season retail sales could obscure the assessment of sustainable demand conditions, making timing of policy easing more complex. Finally, while a sustained fall in food prices eases the burden on consumers, experts and economists do warn it could ultimately hurt farm incomes and slow consumption demand. Fiscal risks also linger if deflation persists across the board. As such, I repeat, caution is certainly warranted, in my opinion, when it comes to another rate cut. Investors should probably also ask themselves at the same time, Indian investors should probably look in the mirror. I always look in the mirror when it comes to making an investor decision, or when it comes to gauging economic data. So probably investors need to look in the mirror, and they need to probably ask themselves, is a rate cut actually needed at this point? Is it really warranted? I mean, okay, fantastic. A rate cut is always positive news for markets. But is it really needed? I mean, the GST rate cuts in late September 2025 played a major role in driving down India's retail inflation by as much as 85 basis points in October, 0.85% in October. Like I said, pushing it to a record low 0.25%. Economists do believe this declining trend will likely to continue in the coming months. At the same time, while moderating inflation offers the RBI more room to support growth, especially given the ongoing external trade uncertainties, strong GDP readings above 7% might actually constrain the ability of the RBI to undertake aggressive rate cutting. Keep in mind that we might be on the cusp of a historic US-India trade deal, actually, which means that the so-called trade uncertainties might actually dissipate in the coming weeks, removing yet another growth barrier and removing yet another defense for an aggressive rate cut in December. Now, in addition to inflation, India's labor market also remains strong. The jobs component of the HSBC India PMI, Purchasing Managers Index, rose to 53.8 in the first 10 months, up from an average of 52.5 during the same period last year. This uptick, confirmed by the likes of RPG, Vedanta Group, as well as other leading economists, shows larger firms are expanding their workforce in response to sustained demand, robust order books, and investments in emerging sectors. Official data further supports this particular positive trend. For instance, India's labor force participation rate hit a 5-month high of 55.3% in September, up from 55% in August. Economists expect that GST and income tax cuts will further stimulate demand, which will continue to drive job growth. Finally, India's unemployment rate for people aged 15 and above eased to 5.2% in the July to September 2025 quarter, according to the periodic labor force survey published by the Ministry of Statistics. Again, more evidence the labor market remains strong, which again begs the question actually, is a rate cut needed? Is another 25 basis point rate cut needed in December? So the RBI does face an environment that is the exact opposite of the Fed. Oh, how Jerome Powell would love that scenario in the US right now. Inflation is cooling and labor market conditions are very strong. And when you factor in the geopolitical uncertainties, in my view, a further rate cut is simply not required in December. If there is a rate cut, which could be the case, I would be more interested in to see the commentary that comes from the meeting, since I would want to know exactly what drove the RBI to make a rate cut. Is something that economists are missing, something that I'm missing, is something that you as an investor is missing? So rate cut, fantastic. Okay, we'll get some we'll get some rally in the markets on Dalal Street probably. But I would be focusing, and I would urge you to focus on the commentary. What did we miss that actually warranted a rate cut? Because if you look at everything, if you look at the holistic picture right now in the Indian economy, then in my view, a rate cut at this point in time would be a rate cut for the sake of one. And I'm not sure whether it's warranted, especially in the coming weeks if any form of trade deal is also in. So I would be more interested in the commentary. That's all I'm saying when it comes to rate cuts and how officials, and I would also be interested as to how officials are seeing the big picture going into 2026, because December, obviously, last meeting of the year. Going into 2026, what additional factors can the RBI and RBI's governor offer in that commentary? So that is what I would be focusing on, rather than the fact that we got a rate cut. Now, the India growth story remains firmly intact, guys. That's what I want you to leave with. The bottom line is the India growth story remains firmly intact. And markets have a lot to cheer, especially as economic conditions remain robust. As such, unlike in the US, I am not sure whether an additional rate cut could contribute at this stage to India's growth story. On that note, I'm going to take you to the final segment, Dr. Dissects, where finally, after weeks of waiting, we finally get a Mag 7's name. One of the Mag 7 giants does go under the microscope. Does go under the microscope this week, and it started with the Microsoft, ticker symbol MSFT. Now, Microsoft started the new fiscal year very strongly, comfortably beating both the top and bottom line estimates. More specifically, Q1 revenues came in at $77.7 billion, up 17% year over year on a constant currency basis, beating analyst estimates by $2.3 billion. Diluted EPS came in at about $4.21, up 21% year over year on a constant currency basis, and comfortably beating analyst estimates by 47 cents. Operating margins were also strong, coming in at 49%, which translates to an expansion of 200 basis points of 2% and an expansion of 410 basis points of 4.1% sequentially, or on a quarter-to-quarter basis. The guidance from the company was also very strong, with Q2 revenues expected to be in the range between $79.5 and $80.6 billion, and operating margins expected to be flat on a year-over-year basis and down sequentially, aligned with historic seasonality. Management's words, not mine. Aligned with historic seasonality. Capital expenditures, a metric that investors keenly watch out for, a metric that's been absolutely without a doubt led to the unraveling of the AI trade. When it comes to companies such as Microsoft, are now projected to not only grow sequentially for Microsoft, but also are expected to have a higher growth rate in FY26 relative to FY25. And you wonder why the AI trade unraveled. Microsoft's stock sank post the earnings release. And here's the conundrum I'm facing. I'm not any Microsoft investor. It's certainly in my watch list, not bought into it yet, but I'm still facing the conundrum. It's very hard for me to identify the precise catalyst behind the sell-off. Okay, since then, the stock has recovered and then some, but I never understood why the stock sank post the sell-off. It was very hard for me to precisely pinpoint the catalyst behind it. I mean, it could be that the stock was at an all-time high going into the earnings, or it could be because of the increasing CapEx spending that the company announced at the time of reporting of Q2 results. And also, as the AI trade was unraveling, Microsoft was also one of the victims. It could be a lot of things. The problem is, if it is the CapEx spending, if it is the increasing CapEx spending that led to the post-earnings sell-off and the subsequent unraveling the AI trade, then the reaction, in my view, is certainly overdone. And you already know my position on this. But I'm speaking specifically from the perspective of Microsoft. This is because if one looks at the overall performance of Microsoft, as well as the underlying demand that continues to outpace supply, I don't see any other option in front of the company other than to spend more. Take Azure for instance, Microsoft's cloud division. The segment came into the quarter with a lot of momentum and has exited the quarter with even more momentum as it delivered a 40% year-over-year growth. And while on a sequential basis, the growth may have only marginally ticked up from 39%, okay, 1% sequential basis. This time last year, Azure's revenue growth stood at 33%, which means that's a 700 basis point or 7% year-over-year increase in revenue growth for the cloud segment. Moreover, the demand for Azure continues to remain strong, as evidenced by a massive jump in commercial bookings, which increased 111% in constant currency in quarter one. The growth does not account for the additional $250 billion Azure commitment from OpenAI, the parent of ChatGPT, that was announced as part of the company's restructuring plans, which suggests that the growth is likely to even continue and which suggests the company is actually not factored in the additional $250 billion. Furthermore, as further evidence of how substantial the demand for Azure is, Microsoft announced that its commercial remaining performance obligations, or RPOs, reached $392 billion, which translates to a growth of 51% year over year. This, ladies and gentlemen, is the highest RPO growth in the last 5 quarters. And given that the growth stood at this time last year at 21%, and now we are at 51%, it reflects the significant contribution that AI has played, both with respect to Azure and with respect to Microsoft 365. What is even more impressive to me is that the weighted average duration has remained stable despite the huge growth at 2 years. The duration, 2 years. It was also notable that management during the earnings call mentioned that there was absolutely sufficient breadth in the demand, numerous products, numerous customers of all sizes, and so on, since this mitigates some of the concentration risk that the company has with OpenAI as one of its largest customers. Given the rapid growth seen in bookings, and given that the company is generating a substantial return on investment on its capex, I don't see any reason for the company to not spend any more on capital expenditures and mitigate the capacity constraints. Company has been spending while maintaining strong margins and strong growth, and with such high demand, I don't think this time's going to be any different. This is primarily why I believe the negative stock reaction post the earnings release is overdone if capex spending was the catalyst. Now, this is not to say that it was a perfect quarter from Microsoft. No, it's far from it. For instance, Microsoft reported a $3.1 billion loss this quarter compared to a $523 million loss during the same period last year. This is a substantial amount. And when asked about it during earnings call, CFO Amy Hood confirmed that it was indeed the case that OpenAI was the driving factor. The investment in OpenAI was the driving factor behind it, which is a substantial figure, in my opinion. Ms. Hood also highlighted in her prepared remarks that going forward, the outlook for other income and expense will exclude any impact from our investment in OpenAI due to the ongoing nature of our partnership, resulting in increased volatility. This is not exactly reassuring to investors because you've gone from 523 million to 3.1 billion now, and you're going to exclude it from other income and expense, which is definitely worrying, especially now that Microsoft will be boosting the capex spending. So this could also be one of the reasons why the stock is down post earnings, and why subsequently, as part of AI unraveling of the AI trade, Microsoft was a victim. So if this is the thing, this is the catalyst, fine, I understand. If capex is the catalyst, sorry, I don't understand. Furthermore, Azure's growth in Q2 is projected to slide down to 37% due to capacity constraints, which could have also triggered a knee-jerk reaction in the stock. Finally, while the company's search business has shown accelerated growth in recent quarters, the growth rate may be stalling or even declining, as evidenced in the recent quarter. While search is a very small part of the company's business, Microsoft's AI moves were expected to keep the segment's growth momentum going, and that has suddenly stalled, and that stalled in Q1. So good multitude of reasons to sell the stock, but if capex is certainly not one of them. Okay. Overall, it was a very strong quarter from Microsoft. Big picture, very strong quarter from Microsoft. Announcement of an increase in capex spending in FY26 seems to have not got down well with the market. However, given that the company's other core segments that rely on these investments are generating substantial growth, and with demand continuing to outpace supply, I just simply don't see a reason why Microsoft should slow down its spending, or how it could slow down its spending. Moreover, it has the cash to spend as well. and it has the cash to spend, as well as it has the cash to return excess capital to shareholders. So I don't see a problem in spending by Microsoft. I just don't see it. I mean, you can obviously in the comment section do lay out your arguments. Happy to have a debate, but as far as I'm concerned, I don't see it. I just don't see it. Now, let's talk valuation. Now I've got all the notes ready, but I will take you through one by one. Now I deployed a Markov switching auto-regressive integrated moving average MS ARIMA model. I'm not going to go into the technical details of MS ARIMA model. It's just a forecasting model, and I use this model to forecast Microsoft EPS for the rest of FY26. All I'll tell you is not without going into much technical details. MS ARIMA is a regime switching time series model that addresses structural breaks, unlike traditional ARIMA models. And Microsoft is a company that has regularly gone through these regime changes, with the AI revolution being the latest switch. And therefore, this Markov switching ARIMA is an appropriate model to predict Microsoft's future EPS. Now, data on Microsoft's EPS was obtained from Financial Modeling Prep, FMP API. EPS for the last 12 quarters was selected to ensure that there was a fine balance between recency and stability. Ordinary least squares regressions were then OLS regressions were then deployed on the 12-quarter window. The model was validated through out-of-sample testing. The last 3 quarters, the out-of-sample testing resulted in the following model metrics. You had the mean absolute error of 0.252, root mean squared error of 0.286. You had the MAPE, which is the mean absolute percentage error of 6.68%, and the model had a 100% directional accuracy, which is also good. And a MAPE of 6.68%. MAPE of 6.68%, this one. MAPE of 6.68%, which is less than 10%, shows that the model is indeed very good for forecasting. So the model was well received. Now, other forecasting models such as Profit and Random Forest, which is a machine learning model, were also deployed. But the MS ARIMA had the lowest errors, had all these lowest errors compared to the other models, which further validated its selection. The MS ARIMA model was then used to forecast the EPS for the next 3 quarters of FY26. This is what we got. For Q2 26, it was $3.84. Q3 EPS, you had $3.96. And Q4 EPS, you had $4.08. And when you include the Q1 EPS as well, you get a total EPS for FY26, $16.01. $16.01 is the total EPS for FY26. Now, according to Seeking Alpha, Microsoft currently trades at a forward price to earnings of 31.72. So when you take 31.72 and you multiply it with $16.01, you get a price target of $508. You get a price target of $508, which is around the levels that the stock is currently trading at. Now, from a momentum perspective, Microsoft momentum has certainly weakened in the last 3 months. No surprises there, as evidenced by the C+ grade on Seeking Alpha's momentum sales. So when you take it all together, the current levels, in my opinion, are not attractive to initiate a position based on my analysis. As such, I'm maintaining my hold rating on the stock, updated price target of 508, but with the caveat that any major pullback in the name warrants a buying opportunity, in my opinion. Finally, I simply don't see for existing investors to exit their positions at current levels, given the strong tailwinds that the company has. Bottom line, Microsoft had a very strong start to the year, guys, with a beat on both the top and bottom lines. Company further justified its massive capex spending, as evidenced by the strong growth seen in Azure, as well as the exponential growth seen in its commercial bookings. Operating margins were also very strong. Post the earnings release, despite delivering a strong quarter, Microsoft stock did fall. It fall as part of the unraveling AI trade as well, made some ground, but it's still down, which I believe could be, if it's due to the significant jump in OpenAI related losses, fine. But if it's projected, if it's related to the capex spending, then I don't particularly agree. An alternative to these cases that I just described could be valuation. Okay, could be valuation, which my analysis did suggest is the case. Microsoft did go into the earnings near all-time highs, so any negative news was bound to get punished. While my rating on the stock is a hold, it's on a pure valuation basis, not due to the fundamentals of the business. And as such, I'm going to repeat the statement here. Any major pullback would be buying opportunity, in my view. Given the negative sentiment I'm currently seeing in the market because of the irrational fear for capex spending, because of the unraveling of the AI trade, I believe such opportunities are certainly going to be around the corner. That's all the time I have for you this week. If you have a specific Indian stock or US stock for the doctor to diagnose and dissect, do tweet me or do to tweet me at Uttam Vinay or email me on the stock doctor podcast@gmail.com. Thank you once again for listening, guys. I'll see you next week with a brand new episode. Until then, stay safe and make some money.